We do pay higher multiple for very good quality businesses, but it is just to be paid for 1, 2, or 3% of the businesses. It cannot be paid for every business. But generally, more than 2 times PAG or the next 3 to 5 years kind of growth rate is where is our threshold where we say, we have to be extremely careful here. So today, for example, pharma is virtually an ignored sector. Not so much has been talked about. Some negative news flow which is there from a US side, all these impact valuations. And expectations run out very single-digit earning growth. So in cyclicals, we generally tend to focus on leaders who have a right to win. And when you're today seeing order books are coming, people are starting to pay for them. Right? Order books they already get priced in fairly early in the cycle.
Hello and welcome to Beyond Returns podcast by ET Money. Today, we are very excited about our guest, Mr. Sailesh Raj Bhan. He is the President and CIO Equities at Nippon India Mutual Fund. Now, Sailesh's performance is nothing short of extraordinary. All the fund that he manages, be it Nippon India Pharma Fund or Nippon India Large Cap Fund, they are the best performing scheme in their respective categories over the past 2 decades. So in this episode, we will dive into his investment philosophy, understand how he invests, and discuss how you, the retail investors, can implement his strategies. So let's get right into the conversation. Sailesh, welcome to the show.
Thank you. Thank you for having me here.
So before we start talking about your investment style, right, I just want to get your views on markets. So I have 3 quick questions. One, about time correction. Just wanted to know, how long do you think this time correction is going to last? Secondly, just wanted to know about the trends in corporate earnings. Do you think they are going to improve? And 3, I just wanted to know what kind of expectations should retail investors have now, considering we've had a really good run for the past 4-5 years?
Interestingly, yes, it's been a time correcting market. And if you just go back a little, you'll realize that we were in very expensive valuations, even bubble zones kind of thing in September last year. And this was building up because we had a phenomenal 3-4 year run post-COVID in the stock market, right? So I think a lot of returns were getting front-ended. And at that point of time, earnings started to slow down post the COVID recovery. So COVID had a very sharp recovery for India in terms of earnings, but after that was slowing down. So markets are now generally tracking what earnings are being delivered by companies. So we have had single-digit earning growth for nearly now 6 to 8 quarters. And that is what markets are generally tracking. So some time correction was certainly warranted. And I think this came on the back of large amount of FI selling, which I think has been on debate by a lot of people. But I think it's thankful that they have sold so much that they have normalized markets in India, and that's possibly again creating opportunities. All the measures which have been taken in the recent last, say, 6 to 12 months, which relates to income tax cuts, which talks about, I think, possibly the GST reforms or the 2 rates of GST now versus earlier, and the tax cuts there are phenomenally beneficial. Actually, in fact, this is possibly one of the biggest, in my opinion, reform kind of an effort which has come about, because this really supports pricing. This really takes pricing back to 2 years, creating an opportunity for demand to grow faster. Because as you all know, consumer demand was suffering for the last 2 years. So I think this is a very welcome move. Lower interest rates, more availability of credit, plus right pricing and effectively optimal taxation. I think all of this in play. So the earnings which have been suffering because of the last challenges of the last 2 years, which is even global challenges and all that, should start improving as we see it. In fact, we see an improvement and in earnings on a reasonably sustainable basis as we get along from here. Now, the second question is what to do with valuations, because earnings is on a positive trajectory, but how much you pay for it, right? If you look at the large cap segment today, we have now come back to nearly long-term multiples. So last 10-year averages have about between 20p multiple. 1 year forward, we are somewhere there now. So I think the excessive froth which was there has also come off, right? And similarly, you have seen many pockets actually, even in small and mid caps, now becoming sensible. Yes, the overall correction in the mid and small cap space is not so vast in the across, but I think you're now finding far more opportunities to do stock selection, effective stock picking than it was the case 12 months back or even 18 months back. So I think markets are getting sensible, earnings are reviving, which I think is the lifeblood of any market, Ravan. I think So I think those things are working in favor, and directionally it's a decent environment to be there. Your last point was on what expectations of returns. See, only earning-led returns are possible. There is no scope for multiple re-rating. Unless earnings really explode, there is no real scope available for multiple re-rating in markets from here on. So I think earning-led return is what should the approach be for investors. And as you know, that earnings generally in India have trended maybe between 10 to 12%. I think the earning-led expectations is what investors should keep, rather than look at any scope for P multiple re-rating.
Essentially, we will be in line with the long-term trends, and investor should actually not be expecting what they have seen in the past 4-5 years.
Those are extreme returns. They won't repeat. I mean, they are not easy to repeat in this environment.
Now, coming to your journey as a fund manager, I wanted to understand, how would you describe your current investing style, and also how it has evolved over the years?
So investing, like we also learn over a period of time, and you get to know the importance of different sets of factors which determine valuation of businesses and investing. So today the basic approach, and in fact we have been doing this growth at sensible prices or growth at reasonable price approach for a long period of time. There are two fundamental principles for this, right? One is you have to choose the right risk to take. In the sense, you have to choose a sustainable, high quality business to invest in. Then it automatically reduces the risk and gives you a greater chance because that business has a right to win. The second is not overpay for growth. We get fascinated by businesses and end up paying disproportionate valuations, which those businesses cannot live up to. I mean, those expectations, because there is always a competitive intensity change. There is always a change which is there. Competition comes, plus business models change. Businesses get impacted and selectively also disrupted. So I think disproportionate overpaying is what we don't want to do, or overpay for growth, but buy sensible right companies and pay them very reasonable prices over time. There is always this debate, whether you buy growth or whether you buy value and all that. I think it's always a combination of it. So what are we trying to do? We buy the best growth companies at sensible value. I mean, if you really are able to take the best of both worlds, and generally it's not available in that context, but we strive to do that at most points of time. So even 70-80% of a portfolio is in that fashion. I think it takes care of a lot of risks.
What about the remaining 30%?
Yeah. See, there are always points of time where you end up paying premium to companies, right, for the longevity of their growth which you believe in. So if you're able to get the quality of the company and the longevity of growth right, you're willing to pay higher premiums to them. But there is a threshold. For example, if you pay disproportionately higher, your IRRs are very inferior. Any example you take, I mean, consumer companies 5-7 years back, prices are virtually flat after 5-7 years in the biggest bull market in India, right? So anything you overpay does not deliver returns for the next 5-7 years, and even if it's the world-class business and the best business also, right? Second is, if you ignore buying the other side of the market, which is, so attractively priced, but near-term growth is not good, then also there's a challenge, because prices may improve faster than the market or the underlying earnings of those companies might improve. So I think the approach is very simple, that you have a combination of a large part of your portfolio still towards growth at sensible prices, and then choose that 1% of the businesses which can actually command a disproportionate premium and have them as a part of your portfolio. Another element is you have to size them well. See, at very expensive prices, if you have disproportionate allocation to those stocks, any shifts in market hurt you very, very significantly. So that is one risk management attempt which we try to do. So simply put, the idea is to make sure that you're creating a portfolio where, at least on a piece of paper, you're able to understand that in normal environments, not euphoric markets or extremely difficult markets, in normal environment, can it give you a reasonable equity IRR over a 5-year, 10-year period? So any stock selection or portfolio construction has this background in terms of deciding or allowing us what to pay and what not to pay, what to own, what not to own, and how much to own in each of them.
So there's a reason why I asked you about how your investing style has evolved over the years. I've heard a lot of fund managers say that when they started out, right, they started out as a typical value investors, and over time they realized that they need to pay certain premium for growth. So was your investing journey also the same?
Interestingly, this whole debate, how the approach is, whether value is important or, like you mentioned, say paying premium for growth. I think at different phases of a fund manager cycle, we keep learning this. I mean, it keeps evolving. So yes, you first start off with the traditional price to earning approach or traditional book value approach when you do it. But as you realize that good companies are able to deliver over longer term disproportionate outcomes. See, somebody growing 4-5% higher because of a very high quality business model and good team is far more valuable than just putting 1 or 2 P multiple higher to growth businesses. So clearly, it evolves in the journey. You learn from what's happening, and actually you reflect more on where you're going wrong at all points of time, and you get these outcomes. So interestingly, paying more for good quality companies is a welcome move. It's not something which is there, and we do pay higher multiples for very good quality businesses, but it is just to be paid for 1, 2, or 3% of the businesses in India. It cannot be paid for every business. Unfortunately, in a typical bull market, every company is benchmarked to a leader's P multiple, and then you give a 10-20% discount, which I think is the reason why bubbles are created, because very, very inferior companies get disproportionate multiples in that. And hence, it's very important to determine which are the businesses which are in the top 1 to 3% of the businesses where you pay higher premiums, and which are the other businesses where in any market they cannot be paid a higher premium. So using PE simplistically is what leads to, I would say, bubbles in poor quality companies at most points of time. In fact, even when we converse with people with 15, 20 years into the market, the real thing is this company is trading at this multiple, this should trade at 15-20% discount to it, and that's how the conversation happens. So that is the core of most mistakes which we make, paying higher multiples to an inferior quality company by using a relative benchmark. So that's what we wish to, or we've learned to avoid over the period of time.
So one quick question here. What is growth at reasonable price according to you?
In growth, actually our definition for growth at value prices or growth at reasonable prices, growth itself we are referring to as sustainable growth or growth which has longevity. Then only you can define how much you can pay for it, right? So what is the growth element has to be sustainable. It cannot be a 1-year growth, but it should be what this company or business can grow for a 5-year period, at least a visible 5-year period. So there is some threshold of compounding which that growth can deliver to us. And then for that asset, how much do we pay? See, end of the day, any asset, any business can be captured is what is its quality of growth and the growth number itself. And second is how much you're paying for that asset. So when you get these two in reasonable, sensible zone, right? Generally we find more than 2 times PEG very expensive, because then there are chances of errors happening, right? In terms of, because 5 years out, you're assuming an X amount of growth rate, you're paying twice that growth rate to be there. Then you end up with, if there are errors, there are challenges. So if you're paying very expensive valuations, we are generally careful. And we also use sizing as a model to reduce the risk there. So suppose we are paying much higher for a business, we may not have the highest size we could have for that asset in a portfolio. So for us, it is clearly saying that what is the longevity of the growth is the first determinant, right? And then how much you're paying for that longevity of growth versus all the available assets in the market. So there are businesses today with, consumer businesses 7 years back at 15% growth rate, we're getting 60, 70 multiple. Today at 12% growth rate or 10% growth rate, they have now come down to 40 multiple. Right? So when you see these kind of expensive distortions in the market, we just tend to have much lesser weight or avoid those kinds of segments which are there and put our capital to work where growth expectations are low and, pricing or valuations are in your favor. So I think it's approaching it like this rather than putting a pure number framework. But generally more than 2 times PEG or a next 3 to 5 years kind of growth rate is where is our threshold where we say, boss, we have to be extremely careful beyond this.
Got it. Okay. Now, broadly, if I look at growth, right, I can look at growth in 2 ways. One is the revenue growth and other one is the profit growth. Now, I just came across some data by Professor Aswath Damodaran, right? He said that in the US, companies which had good revenue growth actually made money for investors, whereas companies that had good profit growth didn't make that much money. I just wanted to understand, what are the growth parameters that you look at?
Logically, in US, it's happened, and we have seen that revenue growth has been a lead indicator to the outcomes which investors have had. I think the basic thing we are saying is even revenue growth should not be bought-out revenue growth. In the sense, it should be natural revenue growth. See, if you invest a lot of money and you get unprofitable business, but you're getting a revenue growth, that is not what we find is valuable. So inherent revenue growth, which is more sustainable revenue growth, is what determines outcomes, because that business model can lead to that kind of revenue growth and that kind of return on equity at the end of the day. So I think so it's not about pure revenue growth. We use a combination of both, but quality of revenue growth is important. So there have been a lot of phases where early stage companies and people in a lot of new age companies had seen 40, 50, 60% growth rate for some period of time. But that is not their long-term growth. That is their growth for that period of time when they are building consumers, when they are doing it. When we evaluate, we say 3 years out or 4 years out, when growth normalizes to these businesses, how much do we pay for that? Right? And at that point of time, what is the size of the business and what is the business model economics at that point of time? So for us, a combination of, it's more like not revenue growth, but quality of revenue growth, and what it means for the business and the business model is what determines our judgment, we think, which is where stock prices in the shorter term do follow faster revenue growth. But I think over the longer term, they come back to quality of revenue.
All right. So next, can you give one or two examples explaining GARP to the viewers? I just want to give them a sense of how GARP looks in action.
Yeah. See, very interestingly, generally you would find businesses either at extreme valuations where there is too much of interest, too much of euphoria, where what real earning expectations are and where valuations stand are very different. So those are separate segments of the market we just have to stop ignoring. Second is come to the areas where you think there is a 5-year, 7-year, 10-year growth opportunity. The first question is, can this business at least be 4 times the size in 10 years? Can this business be 10 times the size in 15 years? So I think if you have that question right, it solves the quality problem and longevity growth problem. Then the next is very simple. After that, what are we paying for that growth? Are we paying 15% for 15% growth? Are we paying 20 multiple, 25 multiple, or 30 multiple, right? If it's sustainable for a 10-year period, you can even pay 2 times PEG, like I said, because that solves the problem of reinvesting, and the company can itself grow at 15% for a long period of time. The benefits are very large, right? That is one. So look at segments and sectors. And also, why long-term growth is important is most companies are priced for the next 1 to 3 year growth, especially in a difficult market. So for example, 5 years back, nobody wanted to invest in largest of largest public sector businesses. Nobody wanted to participate in hotel sector because last 3 years are bad and next 1 or 2 years are not looking good. But there, when you look at normalized growth for these businesses 4-5 years out, they were available at free or bankruptcy valuations, virtually. So the idea is to make sure that you're not buying growth at reasonable prices only for, say, next 1 years of growth, but you're saying what is the sustainable growth and what is not getting priced in. Engineering, manufacturing, all these spaces which have been there, right? I mean, they were all, because the last 5 years are way bad, they were actually trading at distressed valuations then. Today, all these companies are trading at 1 year forward, 2 year forward to 50, 60 multiples for 15-20% growth rate, which I think has turned the reverse. So there are places where we are no-go generally, and there are places which are. So I think it's the middle of the market, and this has got no compromise on quality. You actually get, at most points of time, very high quality businesses at sensible prices if you want to let go the next 2-3 quarters of earnings for those companies. And that is where the meat of our portfolio, the large part of our portfolio is generally focused on. And you're always getting those segments. So today, for example, pharma is virtually an ignored sector. Not so much has been talked about. Some negative news flow which is there from a US side, all these impact valuations. And expectations run off very single-digit earning growth, right? These are places where expectations are low, quality of companies are high, they understand what's happening. And I think those are places where you really get value and longevity both together. And that is where we put in a large amount of capital.
So, in our conversation, you have referred to PEG or PEG ratio 2 or 3 times. Just for the benefit of the viewers again, can you simplify this concept for the viewers? And also wanted to understand that, is this a parameter that's one way to actually check if the growth is at a reasonable price? Thirdly, wanted to understand how do you use it, and are there any shortcomings of using PEG for evaluating stocks?
PEG is very simple as a parameter, right? It's about what you're paying for, what are the PE multiple you're paying for the business, and second today, and what is the long-term sustainable earnings, not the earnings which come in the reported EPS for that year or the next year. But generally, you think that business can be a 13-14% compounder for a 5-year, 10-year period. So that long-term earning is what is the underlying growth which you need to really take when you evaluate, right? what this takes away is, it brings in normal PE for 1 year forward does not talk about the benefits of compounding which come for fast growing companies, right? When you take a PEG, it allows you to have some benefit being given to companies' valuations coming from faster growth or a compounding growth effect for companies over a longer period of time. So today, for example, if a metal company delivers 20% earning growth in a year, it does not mean that, that is a long-term sustainable growth. Long-term sustainable growth might just be 5%, right? Hence, you have to use that as a reference to value it. And similarly, a consumer company today does only 10% growth, but the long-term growth can be 15%. And we can use that as a threshold to give a better valuation to that business versus a metal business which is there. So this allows to differentiate. This allows to take care. The challenge, like I said, with any parameter is how you use it, right? One, it has to be given to only companies where you think there is longevity, there is quality, there is credibility for their growth, or the possibility for their delivering that growth is high. So it cannot be given to every company. It cannot be given to fragile businesses. It cannot be given. So one is that. So that filter itself is the most important one to do it, right? Quality of the company, and then how much you pay for that, right? I mean, can you believe that this company will live for 10 years? So that is the starting point. If you apply this filter to every company and give it for maybe earning growth for companies which is just for 3 years and it may not be sustainable beyond that, then large errors will happen. So I think like every parameter has its ups and downs. I think you have to use it carefully and diligently. But this, if you apply for it, you get a large part of your returns more sustainable, more consistent than you would normally get.
Hi. Before we continue with the conversation, there was one important thing I wanted to discuss with you. More than half of you who are listening to this conversation have not subscribed to the channel yet. If you like the work that we are doing, please consider subscribing. It will help us to get more such industry veterans to this platform to share their knowledge and wisdom with you. All right, now back to the show. So I have one question from retail investors' point of view. Okay. Now let's say some investor is using PEG to understand growth and valuations. Okay. Now, what are some of the other parameters that the investor can combine along with PEG when they're screening stocks?
First metrics are simple. I think the quality of the business should be that, it will work. There should be a longevity to this. There should be a right to win for the businesses. So this can only be applied to maybe top 5-10% of the businesses in India. And generally, that is where institutional investors focus on. And that's where I think 90% or large part of retail investing should also be focused on there. So I think the principle is don't compromise on the quality of the business, which is in a way reflected in how long the business can be successful. Right? That is one fundamental parameter that cannot be compromised on while using PEG, which is there. Please don't apply PEG for inferior quality, fragile businesses or short-term growth businesses, because that is where I think the biggest debacle can happen in investing. So I think it's the quality of the business, and on that, then we can apply this in a range. And in that range, if you're paying more than 2 times PEG, be careful. I mean, don't have larger allocations there, or you really have to believe that, there the growth is disproportionately sustainable. The challenge also comes where you have a lot of companies which don't have earnings today, especially new age companies which are there, where this parameter, it might not be exactly applicable based on what you see today, right? But in that, there is one adjustment to be done. What is a steady state model for that business? What are the economics? What are the business model of that maybe 3 years out or 2 years out? And second is, what is the right for this business to win? So it's like you have this complication of companies which are making losses today, but potentially are new age businesses and can become very large. It's just that you get the right to win of that business, right? And second is on a sustainable basis, what is their earnings, and use that to use PEG, right? So I think some adjustments always need to be done for any parameter to get the best outcomes.
So we discussed PEG, right? Now that makes me curious about one thing. If I have to ask you to tell me one parameter that you think is the most important when you're looking at a company, what would that be?
Any business has a X amount of value, right? I mean, that value is captured in the return on equity that business is earning today, or at an optimal mature stage, what is the ROE that business can earn? That I think is the most fundamental parameter to determine. That tells you about the quality of the business. That tells you about the business having the right to win. That also gives you some sense that the business model has longevity, because somebody's customer is paying you a lot of money and you're able to generate good returns out of it. So that I think is the factor. In some businesses, you may not have ROE today or optimal ROE today, but that is where the judgment comes that whether 3-4 years out, the business will have an optimal ROE or and sustainable ROE. So sustainable ROE, in my opinion, is a very, very valuable parameter when you're choosing businesses in their reasonable stage or mature stage, I would call it.
So my next question is, I just wanted to understand, how can an investor find growth stock at reasonable prices in the current market, right? When everything seems to be fully priced. I've in fact heard fund managers say that all the opportunities and ideas in India seems to be fully discovered.
So it's a very interesting point you made. Actually, this was the case 12 months back where, virtually every stock idea or everything was in a way well captured based on what expectations people had for those businesses. Thankfully, we have seen a consolidation in the market where you have seen overall markets might have been flat, but some pockets have corrected more. Earning expectations of businesses also shifted a little bit because certain businesses are getting into their sweet spot, certain businesses are have been struggling or changing their growth outlook. So I think you will find this market shifts happening which give you these opportunities. The best way to start looking for that, right, is actually to see where expectations have turned very low and prices have started to reflect those low expectations. Like I mentioned, pharma is one space where expectations have turned low, and you've seen some price correction or consolidation in the last 12 months for whatever externalities which are there. So you have to work with a combination of where prices are in your favor and where expectations are low. And if shifts happen, you get, when they come back to long-term growth of earnings, you get back better prices to buy. Most of the times, you will find some pockets of markets which are out of favor and attractive. The only problem is in an extreme bull market or euphoric market like last September, you would find only 5, 10, 15% of the businesses attractive. In this kind of market, you get to 30-35% of the businesses better priced than what has been the case before. And then you have to make choices within the 35% which is available. So I think that is the way we are approaching it.
Got it. So speaking about growth at reasonable price again, so for a manufacturing business, for established business, it's easier, right? But as you spoke, right, new age companies, cyclicals, when you're practicing GARP for these kind of companies, how do you go about it? So specifically, I'm interested in understanding these two set of companies. One is cyclicals and second is new age companies.
Yeah, so it's very interesting. Pure PEG may not work here, but I think there are very, very simple ways of creating. For example, in cyclicals, when they're going through their bad cycle, right, when earning expectations are low and they're going through a bad cycle, that is where you get absolute valuation. Their business is very, very cheap. Like last year or say 5 years back, a lot of these businesses were available at disproportionately attractive valuations because their last 5-7 years were bad and near-term outlook didn't appear very, very good, right? But real potential of those businesses, 3-4 years out, could they earn X amount of money with this kind of an ROE? And do they have a right to win? Existed. I mean, right to win never went around. So large engineering technology companies, which are today priced at 60-70 times, same quality businesses were available at sensible prices based on normative growth expectations which you had put in. So I think it's a function of choosing. There is some way to manage risks. Don't buy bad balance sheets in cyclicals ever. So in extreme cases, they may get very good return, but most of the time they may not reach the destination because they will possibly die in the middle. So in cyclicals, we generally tend to focus on leaders who have a right to win. They should exist 10 years out. Even if there is a slowdown, their balance sheet should allow them to last. Because when they come back, market share consolidation gives you so much of profit that it pays for the last 10 years. And second, don't overpay them after 3-5 years of growth is already built in. And when you're today seeing order books are coming, people are starting to pay for them. I think order books they already get priced in fairly early in the cycle. So I think this is one way to handle cyclicals, where you buy them in the bad cycle. And second, you don't play them for the last 10-25% of the return, because that is where the challenge comes. So after a rally, after a re-rating, you're playing for the next, will get 15% return in a cyclical. Should never buy a cyclical company if you expect 15% return out of it. Because that is where it means you are already saying it's already priced in. I'm playing for the last 15% there. And that becomes more speculation rather than investing, right? And third is, like you said, like the basic idea is prefer leaders in that category. Don't prefer third, fourth, fifth, 10th company just because they are cheap, because they may not last the cycle. And plus, you may not be able to size your investments well in very small companies where, the right to failure is higher than the right to win. Coming to new age companies, I think it's clearly about sizing. Are these businesses and the business opportunities they are in, plus their ability to expand those markets exist or not, right? The minute you are able to judge that, then on a steady state basis, this model can yield a 15-20% ROE and can grow at 15-20% for a 20-year period. If you get this kind of a framework, right, it's very easy to price even new age businesses. Markets have extreme valuations. You have to be disciplined to the price you're paying for that. At the moment, if businesses are not making profits, it does not matter. But is there a right to win? If the business become a duopoly already, right? Only 2-3 guys will have a large part of this market. Can the profit pool of this market 5 years later be a larger sum, and somebody will have 50% of that? So these are factors which come into consideration. But end of the day, in a reasonable business, once it reaches that 15-20% kind of growth rate, which is the good high quality growth rate which exists, on that you're paying some multiple is welcome. But paying excessively for a business model which doesn't have economics or cannot have economics in a 3-year period is highly speculative. So at least a visible 3-4 year time frame, we just have to visualize whether that business has a right to win, has economics working already, and the size and scale of the market is large. If you put these 3 ingredients and then look at new age companies, they become very simple assets to value like any large business.
But tell me something. See, some of the new age businesses can also be very complicated and complex, right? For example, take two-wheeler EVs, right? We don't know what is the size of the market yet, because we don't know whether these two-wheeler EVs will actually replace the traditional vehicles which run on petrol, right? Then there are complications like battery components. China controls the battery component market. So when things are this complicated and uncertain, how do you evaluate such opportunities?
Let us take the EV business in autos, right? And especially maybe two-wheeler EVs or anything that is there. Clearly, the shift to EV is happening. Like you said, we don't know the pace of it. Whether 30% of EVs in India by 2030, vehicles in India sold in two-wheelers will be EVs in 2030, or whether it will be 20% or 40%. That is the debate. So there is some threshold that 20% is reasonably, rationally possible because of what's happening today. So that is understood. Within that, the second question is, what is the right to win for this company or this business to own a sizable share where economics work? Suppose you have 3% share in EV, you have no business model, no economics, nothing there, right? So do you have a 20% market share within the EV segment? And why should customer keep coming back to you? I mean, why should your customer prefer you versus existing OEMs who are also offering fantastic service or who are offering similar EV products which are there? So only companies where we think they'll be able to cross the threshold and win a customer and have some economics, right? If you don't sell 1 million plus, 2 million plus vehicles in India, there is no business model for a lot of those small size EV manufacturers in India. So the idea is to make sure that the business has the right to reach that scale, maybe have a 15-20% market share within the EV segment if it is pure EV businesses, right? And for that, are the building blocks in place? Do you have the technology? Do you have the brand? Are you innovating faster than the existing guys in the system? So I think a combination of these factors are there. If there is no right to win, you've just put capital and you want to win the market. And also you get enough and more signals from the market at different points of time. And those signals actually tell you that, somebody is gaining market share at the expense of others. The net promoter scores of some of these businesses is way higher. The word of mouth is way superior for certain businesses. These are all the early lead indicators which allow you to judge that there is a probability of more than 50, 60, 70% that this AV business might have a 15-20% market share 5 years out.
Got it. So let's say there's a small company, right, which starts to pick up pace and it becomes bigger. So let's say an NBFC or a bank trading at 1 or half a price to book, then goes up to 4 because it's growing fast, maybe 30-35% year on year. So at some point in time, being a GARP investor, you will tend to find the valuations becoming unreasonable, right? And maybe, I don't know, maybe you exit the stock because of the valuations. And if you had held on to that stock maybe for another 3 to 5 years, right? You would have still made a decent amount of money, right? But you exit because of the valuation comfort. Now, I've heard this story for Kotak Mahindra Bank, Bajaj Finance, and many other NBFCs and banks, right? My question is, uh, when you have more than 20 years of experience in markets and you must have gone through such dilemma. With all this experience now, how do you deal with such a situation?
So it happens all the time. I think this is what we are actually paid to manage, right? See, the idea of overpaying for growth, right, has to be done in less than 1% of companies in India. It cannot be done for every company in India, right? And when we see outcomes, we only talk about the survivors and the winners which have remained. So whatever names you would have used have been successful over the years and they have remained, right? But some of these businesses, if you see, have been flat for 5 years also, right? Because if you're overpaying, so it's a question of how much you're overpaying. And second, longevity. How much do you believe in the longevity and the quality of that growth, right? What happens is this becomes very simple that, you've got five successes which have become very big in a 10-year, 20-year period, and they have always compounded and remained highly valued. If we try to apply for every quality company, it is a recipe for disaster. It just ends up in this. So how do we approach it, right? It's about sizing. We also have a very powerful tool as fund managers on how to size these businesses and how to do it. There are so many businesses in our portfolio I've held for all the last 20 years or 17 years, 18 years, right, at different valuations. But we have always worked with sizing. There are times where you own at a particular valuation 3%, 4%, 5% in a fund, and at particular valuation just be 50 basis points or maybe not there in the portfolio, right? And you can actually use that as a tool to manage risk in terms of how much you're paying. And there are enough and more. The market opens every day. It keeps giving you opportunities to buy any kind of company. Most times we are less prepared than the market opportunities which keep coming about, right? So yes, a few companies do deserve, and that is the top 1% or top 0.1% of the companies which deserve very high valuations, and they continue to gain from that. But giving it to every business is where the bigger challenge is. So in fact, a lot of businesses which got, so in the year 2000, you would have seen all IT companies at 100 times, 120 times. I think 50 to 80% of those companies don't exist only today, right? So every company was being compared with the leaders multiple and being given there, right? So the whole idea is to distinguish how much we can own of this. So even for the most valuable asset in the world, if you overpay, you may have 10 years of no return. And that we have seen across cycles. Consumer in 2000, we have seen in so many such cycles which is there. And I think the best thing is to make sure that you are actually very conscious of what you're paying, right? And for certain excellent, extraordinary business, you pay a bit more, but size it appropriately, because you should not end up being, overpaying just for the sake of it. So the minute you are doing speculative valuation for a business, you have to be very, very careful. The minute it goes into the zone that, the business is getting valued for disproportionately higher, it's so many times where you end up with saying that a particular business will virtually have 100% market share when you put the value today in these businesses. But 10 years later, you realize even if they have 25, 30% market share, the returns to shareholders are not great.
So there's one reference that has repeatedly come in this conversation, and you've mentioned sizing many times. So again, for the benefit of the viewers, can you explain exactly what sizing is and how do you actually practice or go about sizing your positions?
Clearly, sizing is the most important tool either for your returns and also for your risk management. I mean, it's a combination of that. If you get a right quality business at sensible prices, but if you buy only 0.5% of that in your portfolio, it does not help you at all at any point of time. So you have to size it right from so what you're paying and how much quantity you're buying. See, what you're buying and what you're paying is one, and how much you're buying is what really determines your long-term returns. And that is where I think the end outcomes in portfolios differ, because everybody knows this is a good company, right? I mean, it's about whether you're buying 0.5% of it, or 1% of it, or 3% of it, and getting it right is what determines your returns, right? So what we do is we clearly have a framework, at least as fund managers and even from our research team, is very clear that these are certain businesses which are trading at outlier valuations, right? They may be good businesses, but even if you buy significantly of those, you may have very inferior returns in the next 3-4 years. The minute you realize that your returns will be way lower than typical equity IRRs you expect out of those portfolios or those stocks, then you tend to avoid those or have maybe much lesser sizes to be keeping the right diversification there, right? And when businesses are extremely attractive on the other side, you don't start off with 50 basis points weight or 100 basis points. You may even size it to 200, 300 basis points. The underlying thing is we are not compromising on quality of the businesses. We are using valuations as a sizing tool to just make sure that they are reasonably greater consistency in the outcomes we deliver. By doing this right over a period of time, you end up with more skill contributing to your returns and less luck or less momentum and more what you can understand, or the stock selection as a factor, giving you greater outcomes to the return. So sizing is a function of, say, I'll give you a very simple example. Suppose you bought a stock which is say 3% of your portfolio, but you expect the stock in things don't happen, you can lose 100 basis points on it or 1% on it. It's a very sizable loss, right? So if you lose 30% on an investment, so when you're buying it, you then size it, you say, well, this is not a 33% bet in my portfolio, this is a 1% bet on my portfolio, because I don't want to lose significantly large part of my capital on one idea which may or may not work, even after I do a lot of research and try to optimize all the factors which are available. So I think clearly it's a return generating tool as well as a risk management tool is getting the sizing right.
As a fund manager, you can go up to 40, 50 or even more than 100 stocks in a portfolio, right? But for a retail investor, what would be a range of good number of stocks in a portfolio?
See, generally, it's been seen that at least you require about 30 stocks to have some kind of optimal diversification, which is there, right? And I think that is valid even for a retail investor. And that provides, some kind of, the correlation becomes a little less heavy and allows for much greater consistency of outcomes. If it is very concentrated, it's not just stocks also, like if it's only from one sector, then the correlation is high and the outcomes can be extremely volatile. See, the risk, every individual has to choose his own risk, right? Suppose somebody wants to have a very high volatility in a portfolio and is able to handle it, it's a different case. But normally, a reasonably diversified portfolio is constructed in 30, 40 stocks and 30 stocks, and that can take care of.
Let's talk about selling. I just wanted to understand your selling framework. So one thing is quite straightforward, right? You would definitely sell a stock if it doesn't meet your thesis or expectations, right? What are the other frameworks that you use for selling?
So like you said, the first thing is what are the assumptions on the basis of which we are kind of investing in a particular business. If assumptions change or those facts actually change in reality, we exit. I mean, you can't change the business of any company. You can only study it and say you're going right or getting wrong and you change it. So one is that is the starting point. Second, if valuations become exorbitant, like you keep a framework of how much you're willing to pay for this type of growth, right? So using the PEG framework, if you are paying disproportionately higher for that growth, then our return expectations they drop dramatically, and the size has to be much lesser. So we start sizing fairly early in the cycle, even on the selling side as well, because that allows you to manage risk and deploy capital in better available businesses there at that point of time. The second is the valuation part. The first is our assumptions going wrong itself, right? The second is valuations for those businesses. And third is risk management. See, there are a lot of risks which we don't understand, which, when they come only you will realize, right? So hence for diversification, a minimum amount of optimal diversification is always required for the portfolio, how much ever you're confident of. And to manage that, we also take profits off the table when you need to be, when there is an opportunity and when their valuation discomfort is there. Our internal learning is, if, like I mentioned, if there is a business and on that some speculation is happening, that's fair enough. That's the stock market. But there are a lot of times where you find there is a speculation on that businesses are getting built. In the sense, the speculative value of that business is way higher. It's going into next 20-year growth opportunity and things like that. And we are already overpaying for that. We correct it.
Would defense be a good example of this? As a sector, I'm saying some companies in between.
Yes, you will find, So in a lot of businesses, next 10-year, 20-year growth, 10-year, 15-year growth gets priced in, right? Based on what we understand today. It's always possible that surprises happen on the upside later on, right? But wherever we find we are overpaying, it's all there in even engineering companies today. It is there in a lot of manufacturing sector. It's there in all these segments where, you're finding that people have stretched the Excel sheet beyond what normally can be justifiable based on our experience.
So this is not directly related to GARP, right? But just wanted to understand one very important factor when investing is also sector rotation, right? So if you have to, again, this can get very technical, and what is done at an institutional level is very different. But let's say if you have to give a framework to a retail investor to understand sector rotation or understand some signs, right, of sector rotation happening, what could be that framework that you can share with a retail investor? What are the indicators that can possibly, signal?
Sectors are in a way like a collection of stocks, so they have that kind of similar characteristics as outcome. So the same principles for stocks also apply for sectors. So for example, if a sector is extremely overvalued, you're finding growth expectations way higher, you start reducing weights in those and move to capital where you find better, or move to sectors or move your capital to where you've got better available opportunities, right? So that rotation happens on valuation one. Second is earning growth. Suppose you have a sector which has a promise of 5, 10, 15 years of earning growth, you keep valuations a little behind and you're still willing to pay for the longevity of the growth. So that is one element you have to choose on. So this comes in the case of young sectors. You've got food delivery, you've got quick commerce, you've got EMS, and you've got these kind of spaces where you can use this. Right. The third is macro conditions, because macro conditions do matter, especially to sectors like banks, where you've got, say, challenges in the macro environment. The impacts are larger because they're all leveraged sectors. You've got in banking, when you lend, there's an inherent leverage built in it, right? So if the macro conditions going bad, you should not have a larger position in it. So you use macros, you use earning and valuation, which is similar to stocks, to size your position. So how much overweight you go, how much underweight you go, or what kind of exposures you would need to own. So macros, earnings, and valuations are the three simple frameworks which allow you to take decisions.
All right. Thank you so much, Mr. Bhan, for joining us and for this wonderful conversation.
Thank you so much for having us, boss. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.